Welcome to our Confidentially Speaking webinar. For those of you who are joining our webinar series for the first time, my name is Elise Margow, founder and CEO of Confidentially Speaking, the home of negotiation. Before we dive into today's webinar topic, in the spirit of conciliation, I acknowledge that I'm speaking on the land of the Bunurong and Wurundjeri people of the Kulin Nation. I pay my respects to the elders past, present and emerging, and also extend my respect to elders of any other communities and cultures present today. Today we are going to explore Warren Buffett's very famous saying, "Price is what you pay, value is what you get," in the context of the sale of a business. I am thrilled to undertake this exploration with Fiona Hansen, one of the finest experts in the Australian valuation world. Fiona is a senior managing director and leader of FTI Consulting valuation advisory team. She has over 30 years, 80 years, Fiona, I'm adding to that, has over 30 years experience in corporate finance, having held senior roles in the big four accounting firms working in Australia, Europe, and South Africa. Fiona specializes in valuations of businesses, intangible assets, equity and debt instruments, executive options, impairment testing, and independent experts reports. She has prepared numerous valuation reports for a range of purposes, including mergers and acquisitions, accounting, taxation, stamp duty, Corporations Act, and ASX requirements. She has also undertaken numerous corporate finance assignments involving mergers and acquisitions, divestments, and financial due diligence. Fiona is a regular contributor for articles for the Business Valuation Australia, Australia's leading industry journal for valuation practitioners, and presented conferences on the topic of business valuations. So as you can see, we have no finer person than Fiona to help us unpack valuations and what they mean in the concept of price. So welcome, Fiona. It's thrilling to have you with us today.
Thank you very much, Elisa. I'm thrilled to be here.
Before we start, Fiona and I ask that you, if you want to contribute, because we're going to be talking and asking questions, but if you want to contribute, please feel free to ask questions and put comments in the chat. And if we have a chance, we will address these as well. So Fiona, hello, how are you doing today? I believe you're speaking to us from a very cold Sydney.
Yeah, thank you, Elise. Yes,
Fiona?
I can hear you. Can you
Fiona?
hear me? Yes.
Okay, sorry, that's better. I can hear you. Yeah, we just had a little bit of a technical problem, but we're back. We were back. So welcome from.
We're back. Okay, thank you very much, Elise. It's great to be here and to explore this topic, which probably can make people's head spins. Yeah, thrilled to hear what you've got in store today.
Fantastic. So, Fiona, I know I've given this, I mean, it's an amazing bio that you have, and there's so much you've accomplished. And I know you've accomplished far more than that and held leadership positions, as far as like accounting organizations are concerned as well. But when you're not your professional self, what are your other interests?
Oh, thank you, Elise. As you said, I've got 80 years to cover it all in. Not a problem. A stroll, a walk in the park. What I tend to do is I like to try to keep fit as possible. And I was probably a lot fitter earlier on in my life and doing many things like horse riding and hockey and athletics and the like. But now I've got a bit more work to deal with and balancing it with my personal life. I'm a bit time constrained, so I am a Pilates addict. I go off with my group of the same Pilates people every morning. So Pilates every morning at 6 o'clock to start my day. When I'm not doing Pilates, I'm doing a run or walking the dogs. I love doing some of the fun runs in and around Melbourne. There's some beautiful ones all through the year, like Run for Kids and the Mother's Day Classic and the Melbourne Running Festival. Those all keep me busy and keep me entertained and keep me focused on staying fit because, they probably every 3 or 4 months. If I'm not out there doing a bit of exercise or in the sunshine or the rain, I like cooking and going to fancy restaurants and spending time at the beach. But as you would have read just recently, I've just been appointed the treasurer of the Kooyong Lawn Tennis Club. So that's another challenging aspect to my life where, all my life I've just been on advisory side. But now I'm given the opportunity to put my hand to work to see if my advice is actually sound.
It's quite something, moving from giving advice to actually doing what you say other people should do, right?
Exactly right. So it's really a challenge for me to step up and I hear myself saying, this is what I will be advising. I've got to step up and actually do it.
That's great. So do you ever sleep, Fiona? I'm just looking at all you do. Do you ever get time to sleep with all this?
Or I'm a sleep addict. So I think me and my girls, I've got 2 daughters, and we both go to bed at 9:30 and wake up at 5:45. So if I don't have sleep, then I can't do anything.
Right. So people might not remember, I spoke to Desi Vlaus a few months ago about mental well-being, and Fiona's just ticked every box. She sleeps, she exercises, and she works. And well done, Fiona, for ticking Desi Vlaus' well-being box. That's great.
And also the food, the fancy restaurants.
Yes. You got to work that out somehow, hey? Right. So let's get back to topic. How you've got this really wealth of experience in valuations, but how did you get into the world of valuations?
I don't know, Elise. I really don't know. A bit of a funny story. So I started coming from South Africa, the traditional route, do your commerce degree, go into a Big Four accounting firm, do your articles or your professional year, become qualified, and then there's probably yourself as well. Once you're qualified, you want to lift your eyes and see the rest of the world. So we packed our bags and went overseas, working with the Big Four firms in, as you mentioned earlier, South Africa, Austria, and Australia. And as corporate finance started becoming refined in the early 2000s, where in order to be given special projects, I fell into financial due diligence. That became a little bit more like a fancier way of doing audits. Got a bit the same, but I like the kick of the deals. And funny story. When I was at a particular accounting firm, one of the heads of the valuations team went on parental leave, and they approached me. And I thought, I'm not a propeller head. I have no idea what betas are. I have no idea what a multiple is. I wouldn't even know how to calculate an enterprise value. So I said, I'll give it a go, but I don't ever want to be converted to be a valuation professional. And the young team members were really good and under their wing and taught me the 101 of valuations. And again, I fell into doing a lot of independent expert reports, and it makes me tick when you're doing something important for a deal. And an independent expert report is really at the pointy end. So the deal is almost about to be done, and you need to put it to shareholders for vote. And one of the things that shareholders need is an independent expert report. So you're front and center in a deal, and you probably play the pivotal role. So that really gave me a good sense of fulfillment and challenge. And because when you have to unpick a deal and look at it from a minority shareholder's perspective and put it back together in terms of valuation, it's really, some of them are quite challenging because these deals are always put together by lawyers, and there's always something something that makes you sit back and say, how do I deal with this in a valuation context? Lawyers
who are not always thinking commercially and financially, right? I won't take it personally. That's why we need mavens like you in the valuation space. So with that in mind, clearly lawyers might have some idea, but they don't really know. And even accountants don't understand valuations to the depth that you do, general accountants. So, but many people find the word valuation quite scary. They think that, only financial orientated people or people, you know, who are auditors, et cetera, would understand this. And they feel, well, we'll leave it to others. We don't need to know anything about valuations and value. Are they wrong in this, these ideas of not needing to know about value?
Absolutely, Elise, absolutely. Everyone in all walks of life comes across some element of having to grapple with this thing about value on a day-to-day basis. So, for example, when you go to the shop and you're looking to buy this jacket or that jacket, and the one is $200 and one's $100. No, there in your head, you're going through, you know, all the things. Why would I prepare to pay the $200 for this jacket or $100 for the jacket? And you're weighing it up, and it's just instinctively, yes, it's a price on the tag, but you're saying which jacket would you prefer to have, and you go through the color and the quality and when you'd wear it and when you wouldn't wear it and how many dollars per wear. That's all valuation if you put it out there in a rudimentary way. Carry on.
So basically, you're saying we've been valuers for years as consumers. We just haven't put that in kind of a logical academic way. We just do it. It's an instinct.
Yeah, that's right. The smaller price tag type things, yes. But if you can imagine when you go to buy a house, to buy a caravan, you know, the stakes are higher.
Yeah.
You deliberate a little bit more. You go and do a bit more research. What did the house next door go for? And what do you think this house is worth? So, yeah, I think as individuals, as the stakes go higher, and the asset gets bigger and it means a lot more, value becomes much more front and center. So when you're buying and selling a business, there's a lot more things that can go wrong in a business. So that's when you appoint someone who's a specialist to understand the aspects of a business and do evaluation.
And so I think you've in a nutshell, when it's small and this stuff, and also what we know about, we've been buying clothes, or we might know a value because we've through experience of something that we're buying or we're selling. But the bigger the stakes, the more complex we need experts in the field. So with that in mind, you know, let's go to sale of a business because that's the topic of our value versus price discussion today. The stakes are high. At most businesses, for whoever's buying them, it's a considerable cost and of time and money. And so they need to know whether A, it's worth it to go into the sale and purchase, and B, what kind of price are we looking at? How am I going to value it so I can put a dollar on it? And so if I was negotiating, how do I use valuation in preparation to start my negotiation? Do you get called in prior to the sale of and purchase of business to help value the business?
Great question, Elise. There's probably two ways which our clients go about it, more from an M&A perspective or from a value perspective. And I'll touch on both. So even if you go to a corporate advisor or a to sell your business, they will do a bit of the back of the envelope, looking at multiples, looking at comparable companies, looking at other various things to come up with how and they probably pretty much go back to price rather than value. We've got a client in the financial services space, and it's a bit of a franchise model. And we have been fortunate enough to represent quite a few of the franchisees, either buying or selling their businesses. So what we typically do in that situation is we run a little bit of run evaluation for them, and we use some financial projections. And we try and come up with a status quo. This is what the business is worth. So we call that fair market value. And then we go and stress test it with them. So let's say we've got some assumptions on revenue is going to grow by 5% every year. Costs are going to grow in line with sales, and profitability. They might have to change over their plant equipment or their computer equipment every 5 years. So we build all this into the financial model, and what we say is we come up with the fair market value. Then we say, okay, well, let's talk to the client, assuming the client is looking to sell their business. Who is the likely buyer? So this is when we start sending from, okay, the fair market value is the joker that I've got in my hand, and I'm not going to sell my business for less than that, because I at least want a rate of return for my business, and I don't want to be squeezed. But from there on, if now we start looking at the potential purchaser, and just like when you go to buy a house, if there's a lot of competition, the buyer's probably prepared to pay a lot more to get the business. If the business, if this business that you've got is very, and the buyer's a little bit desperate, and it's going to be a good fit to their business, they're probably going to be paying a lot. So we just try and stress test and say, okay, so this is the fair market value. And let's say, and we advise a client, okay, if you were going to go into negotiations, which is probably where you come in, Elise, if we value it for $100, we say, okay, well, this potential purchaser has got deep pockets. They desperate for the business. It's going to make a huge amount for their business. So we work out what the synergies would be, and we advise the client go anything between $100 and $200 for the business. Obviously, they start off at 200 and be prepared to be knocked down, but you wouldn't start at 100. You work your way up.
Exactly. Basic positional bargaining, as they say. You don't start at your lowest, you always start higher. And we can talk about anchoring, but that's not the purpose of our discussion today. So you work that you talked about synergies. Some people might not understand what you mean by synergies. What do you mean when you say we will take synergies into account?
So synergies is something where, let's say, assume a buyer, if they got your business, they could make more money for their business than they could do without your business, and you could make owning that other business before they bought it. So, for example, if you have a business already and you're buying another business and you already got an admin function, you don't need to have the admin function. So as soon as you get hold of that business after you bought it, you can get rid of the admin function, and you've got a saving of whatever it costs you to run that admin function. That's a synergy. If you've got, for example, a portfolio of brands, let's say you sell orange juice and you buy another orange juice brand, and you've got 3 other orange juice brands, that's another synergy. So it goes onto the shelf in Coles next to the other orange juice brands, and the consumer doesn't know any better, So you've already got buyers taking that new orange juice, comparing it to your orange juice, so you can be the price leader and the price taker, and have the premium orange juice and the cheap orange juice, and you make the sale anyway.
So that's a bit of... Sorry, continue.
Which you couldn't have done if you didn't have that orange juice you just bought.
Right. And is that, I suppose we would need to talk about, when we're talking about the synergy of the orange juice, I'm not going to give legal advice, but there might be a consumer issue, a competition issue here. So potentially we've got to look at that, and you might need to bring the lawyers in. But from a synergy point of view, it does make sense that you bring 2 types of orange juice under the same kind of business, but marketed separately.
It's surprising how many out there, like pies. If you go to the pie, in the freezer, about 4 of the 5 pies that you see are all owned by the one company. The same as the orange juice. It was a client of ours. They bought another orange juice. The cheap orange juice and the expensive orange juice.
I love it. And we need to do a stress test, like to taste them and see if there's a real difference, right?
I'll tell you which pies not to buy, because they're the ones that come off the dregs at the bottom of the pie.
We'll do that privately. I don't want to be sued for defamation quite yet, Fiona.
No names mentioned.
No names mentioned. So we have a question that's come in. They say, what concepts do you apply in valuing technology businesses that are not profitable? That's quite an interesting question, isn't it? Because specifically in the tech world, we do have a lot of startups where people invest a lot of money into those and buy them in the hope, that they're going to be successful, but you don't really know. So how do you value that?
So generally those businesses are called SaaS businesses, SaaS. And there's actually, it's quite a mature industry, and there's actually a SaaS index. And it's very big in the US, and precisely that those companies aren't making money, primarily because technology is moving so fast that they keep whatever they earn, they plow back into the business to make their technology a lot better. So what these businesses are after is the click-throughs. So for example, software as a service, the more subscriptions you have, the more consumers you have, the more money you're getting. So you really value it over using a multiple of rolling average. So if we assume you've got 6 customers at the beginning of the year and 12 customers at the end of the year, you actually value it as if you've got 12 customers for the full year, and you just do that rolling. So you multiply out your average revenue by assuming you had the 12 customers for the full year, because the next year you're going to have those 12 customers plus some more customers. So there is and companies buy these companies because they've got this, it's the customers, the revenue from the customers, which is far more valuable than actually the sales, because you can actually start selling other services to those customers and for their subscription. So it's not the profit at the end of the day on that particular business, it's the customers which are much more valuable.
That's so interesting. So you're looking to get the subscription base to maybe sell other products through them, and as one of your main considerations in the valuation process.
And then Microsoft will see, this business has got 100,000 customers.
Yeah.
We can flog other stuff through it, and we've already got a profitable business. So that's why they're so valuable, because they can bring all these customers together, get them on a subscription basis, which are sticky. The customer doesn't move, or once the customer starts using that service, it's hard for them to move. It's like your Netflix, you become addicted to
the Netflix way, yes. You've become completely addicted when Netflix asks you, are you sure you're still watching, right?
So to answer your question, if it's SaaS businesses, that's the way to do it. But if it's an RT business that's not making money, it's either a bum business or they've bitten off too much they can't chew, and the thing will never develop and will never be commercialized, or they're spending too much on the development. Sometimes we value businesses on a net asset basis according to international valuation standards, and you've got to ask your question: every dollar that you spend on development, is it worth $1? Or how much or is it only worth 20 cents because you spun your wheels and you didn't know what you were doing, and you mucked around here and you mucked around there, you tried this, you tried that. So often, it's often the case where early stage companies are spending hundreds of millions of dollars to develop a concept, but also there's other people out there got a different way of looking at this concept and might beat you to market. This was the same sort of concept.
Yeah. And so, and the part of it is, if you're selling, you're hoping someone will think, well, I know you've spent this amount of money. I'm prepared to take maybe the debt off you and take over the business. And then I know how to market it better. I know how to deal with it in a way that is going to be more successful in the market. That would be the potential purchaser that you'd be looking at in that case.
Well, the thing is, those businesses could never get any debt because there's no hard assets. No one's going to lend you money. So it's your friends and family, private equity, suckers, if you wish.
Oh, you can say that.
and the government grants, we've met some entrepreneurs who are developing stuff and they just get addicted to the government grants. So for every, I forget the number, but for every dollar they spend, they get 70 cents from the government through a grant, and they just keep going. Biotechs are
if I'm coming, so for the purchaser, it's like literally you could offer practically anything to take this problem off their hands because their business is going nowhere. Is that the kind of value that we're talking about? Or
I think a lot of these high-tech businesses are actually out there to develop something. It's like a junior miner.
Yeah.
They are starting to develop something. Then the big companies are looking, because they're just so mature, let's say Google, they're looking for the next best thing, and they're looking at all these little developers out there. These smart guys are developing something which will fit nicely with my existing product offering. Slap it in there and pay them out, and they've saved me the heartache of all the initial development research and all the rest of it. Even if it's 70% of the way there, it's saved them all that, maybe 3 years of development, just picking it up.
And so from a negotiation perspective, the seller would say, look, this is what I've saved you. So this is what in developmental costs. So this is what I'm putting into my sale price.
Well, I think maybe in that early stage, if you've got something that was 70% developed, I don't know whether you're a price or a price,
Yeah,
I think you're so deep in owing favors to friends and family for the money that they've tipped in that they might not get back.
Yeah.
Any dollar you can get, you'll take.
So basically, if I've got money and I'm in that space, really look out for these guys who have some great ideas and move on, right? Yeah. So and get things very cheaply because you're dealing with a stress seller. Now, I have so many questions, Fiona. The chat is going a bit viral, but let's start with this one. In practice, what happens if the client is not satisfied with your valuation?
They go get another one.
And okay, so that brings me. So you get two valuations, and
you're satisfied with neither of them. Go get another one. Will you pay $50,000 for each? And so sometimes you're better off just running with the one, because if you have three valuations and they're all different, what are you going to do?
So this is the problem, right? So is it for me to say, look, I'm not happy with the value? Like, if I should really look around and make sure the person I appoint is the appropriate valuer for that business and has experience in it. But also I should, and I always say this, I should actually negotiate with the valuer and say, this is what I'm looking for. We need to have hard conversations. This is what I'd like. To see, and this is what I think you should be looking at, and be prepared to say, well, this is the expert. If I trust the expert should be honest with me and say, oh, maybe Elise, you have a point, or maybe you don't, sorry, that's just not appropriate. Is that correct? Or
well, seriously, if you don't like the valuation, I think the person who doesn't like the valuation needs to really pare it back. So there's only two things can go wrong. The valuer has stuffed up the calculations, or two, the data that's been put into the valuation is wrong. Yeah. So the data that's put into the valuation is the client who's provided their data. So 90%, 95% of the value is reliant on factual data, the profits and loss, the forecasts. If that's wrong, the value is going to be wrong. But if the valuer uses the wrong methodology or does stuff up in the calculations, fix the calculations, and you get the right value.
Yeah. But I always see, we have these cases I've seen where, like, you have two valuers, both have a point, and the judge has to make a decision whose value is more correct based on methodology. That is quite extraordinary in some ways, because for those of us who are not that value minded, as in the nuts and bolts of valuation, we kind of go, well, aren't you using the same methodologies? How come you're coming up with such different values that we actually need a judge to make a decision?
I could speak all day on this. The poor judge, he's going to be an expert in this 1 hour and another expert in something else in the next hour. He's never going to be an expert in valuation.
Yeah.
And again, these lawyers are very clever, because one lawyer can brief their valuation expert one way and focus on a particular angle of a question, and another lawyer can take the same question and focus on a slightly different. So in actual fact, you're not having, both valuers are not getting the same instructions.
Yeah, and I think and I suppose that's when a judge might say, I'll instruct on behalf, and we'll get an independent valuer who's not briefed by either of you, right?
So one valuer's got, gets the right, so the lawyers need to work out what the right instructions are.
Yeah. Exactly. And so you're all valuing on the same basis. So now something a little bit different that's come in. As I said, the chat's going a bit viral. In a listed company context, what value difference do you apply for a control interest versus a small shareholder holding? Well, I've got professionals out there. That's what I'm thinking.
Discounts and premiums, another big... Another can of worms.
Yes.
So typically the share price of a company is on a minority basis, because it's the mums and dads and it represents one share, because they one share. But if you're going to value a whole business, you pay you're probably prepared to pay a premium, and premiums can vary. So if an industry is hot, then, as I said before, that if a lot of buyers for whole businesses will be gunning for that industry. But if it's not a sexy industry and it's like maybe building materials, the control premiums are going to be much smaller. But if it's SaaS type businesses, the control premium is going to be higher. So what we typically do is a control premium study or a M&A premium study, because you can't really say it's a control premium, because, as we said before, people are prepared to pay a premium for synergies and control. So if you observe transactions of whole companies in a particular specific industry over a certain time period, you can see a bit of a trend, what sort of premiums they pay on average, median, high, low. That's the premium. And then it's up to us to do some analysis to work out in each specific transaction, how much do we think is control premium, how much is synergistic premium and other premium. And then we work it out that way.
Wow. Okay. And so, I mean, we're now talking about shareholding, but when we sell businesses as well, there are asset sales where you don't buy shares. And I guess there's the legal and the commercial reason why you wouldn't, you would choose equity, that shareholding, over purchase of assets. And that would obviously be you'd be looking for control in the purchase of a business instead of investing as a minority in a business. From a valuation perspective, how can you help the buyer work out whether it's better to purchase the shares in a business, maybe they get more value, versus the assets?
I think so. When you say assets, you actually mean enterprise value, or you do mean because if it's a let's say a land holding business, and you can value the sum of the parts, all the parcels of land. But if it's a manufacturing business, buying the machinery and the factory is not a business, because you need the staff and you need all this other stuff to make the business operate. So when you say assets, I interpret that to, okay, I'll buy the business.
Yes.
Not the shares.
That's exactly. So basically, I'm talking legal speak now. We often talk about a share purchase versus an asset purchase. An asset is the enterprise. So you're buying the business, but you're not buying the shares in the company that holds the business.
Yeah. So there's a real tension between the buyer and the seller in situations where the seller wants to sell the shares, and get rid of it, but the buyer only wants to buy the business, because, as you know, shareholders can do some really funny things.
Yeah.
And tax is an issue. So it actually really doesn't necessarily come down to value. It comes down to what the risks the buyer and the seller are wanting to take on or prepared to take on, and what they don't want, what they want to get rid of. So
Yeah.
that's the real tension, and that's where the negotiations come in to play as well. So both the buyer and the seller have gone and done their own DD as to what they think, because if there's a tax debt or the tax officers after them, or they haven't paid their payroll, or there's, anything that could have happened, they don't want to be on the hook buying the shares 7 years down the track. Because even if you put warranties in the sale purchase agreement, warranties are not worth the paper they're written on,
I love that, Fiona. You've just dispelled every bit of writing that the lawyers put their copyright on their warranties. But you're absolutely right, practically. And that's why the negotiation is so important. At DD, or due diligence, as you say, is so important, because at the end of the day, if the business is bad, trying to sue a shareholder because you've bought a debt or a tax, there's a debt attached to the business that you didn't know about, or a tax issue that you didn't know about, or litigation you didn't know about. There's not much you can do except waste time. Should I say that? Waste time in court trying to resolve it instead of building the business. So you're absolutely right. We can put warranties in, but at the end of the day, we've got to be cautious. So, but I guess then you would value shares differently to the enterprise. And have you ever been asked to value both the enterprise and the value of shares for the for a potential purchaser before?
Well, generally, we always start off with valuing the business.
Yeah.
We've got to value the business, and the difference between the business value and the equity value, as we call it, is any surplus assets. So assets that are not used in the core business, that don't generate the profit that you've used to value the business. Any debt, because you generally value the business on an ungeared basis. So the value of a business shouldn't be worth more if it's 100% equity funded versus 100% debt funded. So the business is the business, it should be worth the same. With the same. The difference comes into how much equity and how much debt, and that's so. Then when you value the enterprise value, then you add the surplus assets, which is land. Which is just an investment piece of land, and the debt, the funding for, let's say, lease sale purchase agreements for plant and equipment, and then whatever's less is the equity value.
Right. Yeah, that makes sense. So, and so basically, if we were looking at it, we'd ask for that kind of valuation anyway, which would look at the enterprise, but also the equity, and then figure out. So it's part of the same structure.
Because by the time you get into negotiations with the buyer, they don't want to take the land. So then you don't add the land back. And they say they don't want to take the debt. So you've got to add the debt back. And then you get back to the enterprise value, because they wanted it on an ungeared basis, which is the enterprise value.
So for someone who doesn't understand financial speak, what does ungeared mean?
So ungeared means no debt.
No debt. Okay. So we talked about ungeared, and now I'm going to move a little bit into the small business and innovative businesses that we've been talking about, because in larger businesses, generally there is better documentation around purchases, and it's sometimes easier to look at markets that work within those businesses. But with a smaller business, we often find there's very little paperwork, there's very little trail, there's very little information available to a valuer. How do you piece together a valuation in those circumstances?
Very difficult, and it reminds me of the time when we valued a fish and chip business. On near Brighton somewhere, and the guy owned a fishing boat. He bought the fish and sold it through the fish and chip shop, and that was before COVID. So there was a lot of cash which was happening, which he wouldn't declare. So when he wanted to sell the fish and chip business together with his fishing license, there was nothing. So we had a look at this and we thought about it and we said, well, no one knows how much sales you make and no one knows how much profit you make truly, except for what you put on the tax return, which is next to nothing. So for umpteen years, you've got away without paying any tax. Haven't you already been compensated for your business?
So that's okay. Because you didn't pay tax, and hopefully no one will find out. Theoretically, you've made your profit now. Just sell it's like just the bibs and bobs of a fish and chip shop.
Yeah, that's right. So take what a potential buyer will give you, because whatever they give you is lucky. You're lucky.
Yes. You see that's the issue, isn't it? And so many times I look at things and go, well, yeah, because obviously I spend a little bit of time in the smaller business end, and there's firstly that very busy. It's not always, most times it's not a tax dodge. It's just very busy. Haven't got time. One or two people running a business don't have time to put things together, but when you want to start preparing for a sale, so much is lost. So part of, I guess, the warning we'd say is if you're building a business with the hope of selling it, start keeping your documents well and truly kept for people like Fiona to come in and give you the best valuation.
Well, that's what they say, investor ready. So there's a lot of services out there that if you're intending to sell your business, the timeline is quite long. So because you need to have at least 18 months to 2 years worth of trading, which is evidenced in proper documentation, so a buyer can come and do some proper due diligence and be satisfied that the business is earning what you say it's earning. Likewise, when you do an IPO, the ASX and the Corporations Act and all require a certain level of and length of time period with good documentation, so that because it's all in the prospectus. If you can't put numbers in there, you can't substantiate, and subject to proper and thorough due diligence. So it takes a good 18 months to 2 years to get a business up and ready for sale. And the better the documentation, the higher the price you can command, because the buyer will have a lot more assurance as to what you say you've actually got.
It's quite something, isn't it? When we've got the and I think part of it is we don't think about it. We think if I want to sell a business, then I'm going to want to sell it now. Actually, you should start preparing well before. Another question's just come in. Can you describe one of your more complex valuations?
Complex. Whoa. It can be complex in many ways. It can be complex in terms of what we've got right on the table right now is a business which has operations in Australia and operations in Asia. Again, the documentation is all over the place. So you've got Australian dollars versus, let's call it, Hong Kong dollars. And the one entity owns 100% of the other. So it's going to be difficult to convert everything into one currency. So this is some of the things we had to think about. It's hard to convert all the Hong Kong dollars to Australian dollars because you've got forecasts and you've got historical. What rate do you use? Or maybe the better way to do it is value the Hong Kong business in Hong Kong dollars and get a value, and value the Australian business in Australian dollars, and then convert at a point in time the value of the Hong Kong as of today, say, into Australian dollars and add the two together.
That does sound complex, especially because currency fluctuations at the best of times really complex.
And then you throw on top of that if you've got options as well, if they've issued options to the employees. How do you deal with that? Because you don't have only the ordinary shares when you come up to the equity value. You've got these options as well, or convertible notes. So then you've got to go and value these convertible notes and options, and you deduct it off the value of the enterprise to get the pure ordinary shareholders. Then you've got a 50%, or let's say a 60% shareholder and a 30% shareholder, and you've got to value their holdings each. One's got a control and one hasn't got control. Yeah. A lot of valuations are generally complex, and I would probably say it's hardly any that are cookie cutter, because if you think it's cookie cutter, you're missing something. Go back and have another look.
And I think that's the point, is that for everything, nothing in these sale and business transactions, nothing's a cookie cutter. Using precedent, whether they valuations or contracts, it means you don't have the true customized deal that you're doing. Your transaction is just no one transaction is the same as the other. No person, seller or buyer, is the same, although they may have similar needs and wants. So that's like negotiations as well.
Exactly right. Yeah, exactly right. No business is the same. Like Telstra is not the same as Optus. It's not the same as Vodafone. It's not the same as TPG, you know?
Exactly. So, Fiona, I think our time is running out. I could speak to you all day on this. You make valuations fascinating, and that's fantastic. And that's, all these questions we're getting has been amazing as well. So, firstly, thank you so much for joining us today and giving us a wealth of your 80, or should I say 30 years experience in the field in a way that is easy to understand. But if people want to get hold of you and find out more from you, how can they get hold of you?
I think you do a great job in your LinkedIn, Elise. And I will go and like and follow you, so you can find me on LinkedIn. Otherwise, I work at FTI Consulting, and we've got a fantastic website. It's probably a little bit convoluted, but I must say it's been an absolute pleasure talking to you today on what can be a very dry subject. You've made it absolutely great fun, and we've got some funny stories and some funny examples. I made a lawyer laugh today.
I just love that, isn't it? It's like, that's what it's all about. So thanks, Fiona. And I'm going to do a little bit of marketing. Confidentially Speaking, you can find us on our website, www.confidentiallyspeaking.com.au. You can find me, as Fiona says, on LinkedIn, where I give a few tips and traps of negotiations, and I link you to wonderful people like Fiona. And finally, if you're interested in our masterclasses, we are having a masterclass in March over 2 nights, and it includes, after the masterclass, one-on-one coaching with you to distill what you've learned. So please have a look at our website. Thank you for joining us today, and have a lovely day, and enjoy valuing whatever you want to buy from a consumer perspective, having had the expertise of Fiona show you the way.